People like to believe that markets are complicated because the numbers are complicated. That is not usually the real reason. Most of the time, the danger comes from something much simpler. Too many people begin to believe the same thing at the same time. They position for it. They borrow for it. They talk to one another until the belief sounds like fact, and then one pressure point changes. When that pressure point changes, the whole arrangement that once looked intelligent begins to look fragile. I have watched that pattern all my life. I have watched people crowd into glamour stocks because they believed growth was permanent. I have watched them crowd into leverage because low rates looked like a law of nature. I have watched them crowd into real estate because a rising price convinced them that a good asset could never be overowned. The surface changes from one cycle to another, but the mechanism underneath it does not change very much. A crowded bet can look safe right up until the moment it begins to reverse. Then all at once the crowd discovers that its greatest source of comfort was also its greatest source of risk. That is what I believe happens when too many people lean against the dollar at the same time. Most people do not think about it that way. They think about stocks, they think about rates, they think about oil, they think about inflation, they think about Europe, they think about the Federal Reserve. They think about one chart at a time and one headline at a time. They do not stop and ask the more important question. What position has become so popular, so comfortable, and so widely spread through the system that even a modest reversal could force people to sell what they love in order to buy back what they dismissed? When I read a setup like this, that is the first question I ask. The most dangerous trade is often not the one everybody is frightened of. It is the one everybody has learned to live with. It is the one people stop naming as a risk because it has become part of the background. They assume it will remain there quietly while they pursue returns somewhere else. The dollar can become that kind of background assumption. A great many investors do not wake up in the morning and say, "I am making a giant active bet against the dollar." They simply structure portfolios, financing asset allocations, regional exposures, and risk budgets around a world in which the dollar is not going to cause them trouble. That is still a bet. And a bet becomes more dangerous when it is hidden inside other bets. If money managers have grown comfortable owning equities because they believed the Federal Reserve would cut rates, that is one layer. If traders have grown comfortable favoring Europe or other assets because they believed the dollar had already peaked, that is another layer. If institutions have treated energy pressure as temporary and assumed growth fears would quickly force central banks back into easy policy, that is another layer. One layer on its own may not break the system. 3 or 4 layers resting on the same assumption can create exactly the kind of instability that turns an ordinary reversal into something disorderly. That is why I pay attention when currencies and rates at the same time. The old comfortable script went something like this. Growth would soften, central banks would become more accommodative, the Federal Reserve would cut rates. A softer American policy path would keep pressure on the dollar. Risk assets would remain supported. If the dollar drifted lower, global money could keep seeking returns in equities and everything would feel manageable. That script was never guaranteed, but it was widely believed. Then the pressure point began to move. Oil started to matter more than people wanted to admit. That is always worth studying because oil is not just another commodity. It is a tax on activity, a tax on transport, a tax on businesses. And in some regions, it is also a tax on national vulnerability. The same rise in energy prices does not hit every economy with equal force. That distinction matters. Europe does not experience an energy squeeze the same way the United States does. A region that depends more heavily on imported energy can see its trade balance deteriorate faster, and its currency weaken more visibly when energy costs rise and remain elevated. That is not a side note, that is the hinge. If the euro is the largest component in the basket against which the dollar is often judged, then weakness in Europe is not just a Europe story. It can very quickly become a dollar story. And when the dollar story changes, the equity story often changes with it. I have always tried to keep investing grounded in sequence. What happens first? What happens second? What has to happen because something else already happened? People get lost when they skip that discipline. They jump directly from a headline to a conclusion. I prefer to walk through the chain. First, energy pressure rises. Second, Europe feels that pressure in a more vulnerable way because imported energy becomes more painful, and growth was already weak. Third, the euro comes under pressure because the region begins to look more fragile. Fourth, expectations that had leaned on an easier Federal Reserve begin to wobble. if energy also complicates inflation optics in the United States. Fifth, the crowded short dollar view loses part of its intellectual support. Sixth, positions that were built on dollar weakness begin to reverse. Seventh, investors who used borrowed dollars or implicit dollar weakness as a way to support long-risk positions have to reduce exposure. Eighth, the market experiences stress not because everyone suddenly discovered a new truth, but because everyone tried to exit the old truth at once. That sequence matters more than any single dramatic phrase. I do not need dramatic language to understand why a crowded short dollar trade can threaten equities. If you sell dollars in order to own something else, then at some point, if the dollar rises and your financing logic reverses, you have to sell the something else to buy the dollars back. That is not ideology. That is plumbing. The market can ignore plumbing for a while. It cannot defeat it forever. This is where experience helps. When I was younger, I learned that many investors like stories that move in a straight line. If rates come down, equities go up. If inflation cools, the central bank eases. If growth slows, policymakers respond. If a trade worked last quarter, maybe it will work next quarter. Real life rarely gives you a straight line. It gives you pressures that collide. An energy spike can hit growth and inflation expectations in conflicting ways. A weak economy can coexist with an uncomfortable central bank. A market that expects relief can discover that relief has been delayed. Once that happens, assets priced for comfort must reprice for disappointment. That is the part many people miss. They think the danger begins when the economy gets worse. Often the danger begins earlier when the market realizes that the policy response it expected may not arrive on time. If the Federal Reserve is no longer eager to deliver the cuts investors had leaned on, that changes more than a forecast. It changes the emotional structure of the market. A great many positions in modern markets are not built on present cash flow alone. They are built on anticipated policy. Investors buy the idea of support long before the support appears. If the support gets postponed, those same investors discover that a future benefit had already been priced into a current portfolio. That can be a rude awakening. And it becomes even more dangerous when Europe is simultaneously losing altitude. A weakening euro during an energy squeeze tells you something important. It tells you that the market is beginning to price the vulnerability of the European economy more seriously. If that vulnerability deepens while the European Central Bank cannot confidently deliver what hawkish expectations had implied, the euro can weaken further. Once the euro weakens further, the dollar does not need universal enthusiasm to rise. It only needs the reversal of a crowded consensus. Markets do not need everybody to change their mind. They only need enough people to change their position. That is why I care about positioning so much. Valuation matters, business quality matters, management matters, but in the short run, crowding matters too. A good analyst who ignores crowding can be right in theory and wrong in calendar time. If too many participants occupy the same side of a trade, calendar time becomes brutally important. Forced buying and forced selling do not wait politely for thoughtful investors to finish their memos. When institutional flows begin turning, I pay attention, not because institutions are always wise, they are not, but because institutions are large, and size turns opinion into impact. If managers who had been leaning one way start cutting exposure, that is not merely a sentiment change, it becomes a mechanical influence on prices. A market can absorb debate. It struggles more when it has to absorb liquidation. The reason I connect this back to stocks is simple. In periods when the dollar is drifting lower or staying contained, risk assets often breathe more easily. That does not mean a lower dollar magically solves every problem. It means the environment feels friendlier to the kinds of trades investors prefer when confidence is high. If that same dollar begins to rise sharply, some of that friendliness disappears. Funding assumptions tighten. International exposures feel different. Relative growth judgments shift. Hedges become more expensive. Weak hands that were comfortable with risk start looking for the exit. You can see this pattern in market behavior over and over again. The dollar strengthens. Equities lose some of their ease. Corrections become more probable. Narratives that previously reinforced one another begin to conflict. A market can survive that, but it cannot glide through it as if nothing changed. The energy piece remains central because it affects both the real economy and the policy imagination. People often oversimplify inflation. They hear higher energy and think persistent inflation. Sometimes that happens. Sometimes it does not. A more subtle outcome is also possible. Energy rises. Headline inflation pressure looks ugly for a while. Households feel squeezed. Real purchasing power weakens. Growth suffers, and eventually the inflation impulse rolls over because consumers simply cannot sustain the higher prices. That kind of path is not comforting. It can produce a brief inflation scare without durable prosperity. It can wound demand even as it confuses policymakers. That is why elevated energy can be so destabilizing. It does not have to generate long-lasting, healthy nominal growth to cause damage. It only has to arrive at the wrong moment and hit the wrong balance sheets. And balance sheets, unlike opinions, do not forgive easily. If households are already stretched, higher energy costs bite quickly. If businesses were already navigating slowing demand, higher input costs reduce. If Europe was already soft, a new energy burden can push the region toward a more obvious slowdown. If central banks fear acting too soon, rate cuts get postponed. If rate cuts get postponed, the dollar can find support. If the dollar finds support against a market that had leaned the other way, the unwind begins. Everything connects. That is the sort of situation in which investors get themselves into trouble by focusing too narrowly on one asset. They stare at the stock chart but ignore the currency chart. They watch the currency chart but ignore oil. They watch oil but ignore the policy path. They watch the policy path but ignore positioning. By the time they notice the links, the adjustment is already underway. I have never liked investing that way. I want to know where the pressure can migrate. Pressure rarely stays where it begins. It starts in oil and shows up in currencies. It starts in currencies and shows up in equities. It starts in policy expectations and shows up in portfolio losses. If you follow the migration of pressure, you are usually earlier than the people who wait for confirmation in the final asset. In this case, the migration is not hard to imagine. Oil remains elevated. Europe struggles. The euro weakens. The market reduces expectations for American rate cuts. The dollar rises. Crowded short dollar positions start hurting. Institutions reduce equity exposure. Correlations that once felt mild become more obvious. People who thought they were diversified discover that they were diversified inside the same macro assumption. Then what looked like several independent positions reveals itself as one large shared mistake. I have seen many shared mistakes. They tend to be wrapped in respectable language. People call them tactical allocations, factor tilts, regional opportunities, momentum extensions, relative value expressions. There is usually intelligence behind the individual pieces. The problem is not that every participant is foolish. The problem is that many intelligent participants can still produce a foolish aggregate position when they all move together. That is one reason I have always preferred simpler structures and durable margins of safety. I know that a crowd can stay enthusiastic for longer than logic suggests, but I also know enthusiasm eventually encounters arithmetic. A crowded short dollar trade encounters arithmetic the moment the dollar starts to rise faster than expected. Then the financing cost changes, the mark-to-market changes, the appeal of patience changes. What had once been a calm relative value idea becomes a painful risk management problem. People often talk as if squeezes belong only to dramatic speculative names. That is far too narrow. A squeeze is simply the market's way of punishing a crowded position that relied on one directional assumption. It does not have to happen in a meme stock to be dangerous. It can happen in the most serious parts of the global financial system. In fact, it can be more dangerous there because those positions touch everything else. Currencies touch everything else. If I were explaining this to a young investor, I would say it plainly. Do not ask only whether you are bullish or bearish on the dollar. Ask what the market has assumed about the dollar. What other assets have been made to depend on that assumption, and what forced behavior would follow if that assumption cracked. The forced behavior is where the real damage happens. That is also where the opportunity eventually appears. But opportunity comes later than most people want. First comes stress. The reason I do not rush to celebrate a future rebound when a crowded trade begins to unwind is that markets usually overshoot on the way down before they create clean opportunities on the way up. When participants are still discovering where the real pressure points are, price can move faster than reason. A short squeeze in the dollar can combine with equity liquidation, ugly headlines, and policy confusion. In that phase, I am not searching for drama. I am searching for evidence that the forced selling is becoming mature enough to create genuine bargains. That is different from guessing. Too many investors want to call the turn before the turn is investable. They see one bad day and tell themselves the panic is complete. They see one bounce and tell themselves the danger is over. I prefer to wait until the mechanism has done enough damage that the probabilities improve. Until then, the disciplined response is not heroic forecasting. It is risk control. Risk control is not fashionable in bull markets. It becomes fashionable only after the losses arrive. I think that is backwards. When the market has crowded around a single macro comfort, the right time to reduce risk is before the crowd decides it wants out. If the crowd has already started running, you are negotiating with a worse price and thinner patience. That does not mean abandoning investing. It means trimming exposure when the backdrop that supported the exposure is beginning to change. It means admitting that not every dollar of capital must remain in the same place, merely because the recent past felt kind. A sensible investor can reduce some market exposure without pretending to know every short-term move. A sensible investor can hold more liquidity without becoming paralyzed. A sensible investor can recognize that a stronger dollar may serve as a hedge against the very stress that could hurt equities. None of those steps require prophecy. They only require humility. Humility is underrated in markets because certainty sounds more persuasive. I have never found certainty particularly reliable. What I trust more is a chain of incentives. If the Federal Reserve is less likely to cut than the market expected, that supports the dollar relative to what had been priced. If Europe is more exposed to energy pressure than investors hoped, that weakens the euro relative to what had been priced. If the euro weakens and the dollar rises against a backdrop of crowded short dollar positioning, then some market participants will be forced to react. If they react by reducing risk assets, the equity market faces pressure. If that pressure accelerates, fear itself can become another fuel source. You do not need perfect foresight when incentives line up like that. You only need to avoid standing where the falling furniture is likely to land. There is another subtle point here that deserves respect. Markets can spend a long time training participants to ignore old dangers. If a lower dollar or easy policy backdrop supported risk for a while, investors begin to think of that as the normal environment. They build language, models, and habits around it. Then when the environment changes, they initially respond with disbelief. They tell themselves the move is temporary. The old trend will resume. The central bank will rescue them. Europe will stabilize, oil will cool, the squeeze will fade. Sometimes those things happen. Sometimes they do not happen soon enough. Timing is where many portfolios break. Even if someone remains correct over a 12-month horizon, a violent 3-week adjustment can still inflict enough damage to force ugly decisions. That is why leverage and crowding are such poor companions. They turn time into an enemy. The investor with no leverage can tolerate more volatility. The investor depending on a continuing macro trend has much less freedom. Freedom matters. It gives you the ability to outlast temporary discomfort. Without it, you become another participant contributing to the very move hurting you. That is one of the reasons I have always admired strong balance sheets in businesses and in portfolios. Strength buys patience. Weakness sells at the wrong time. I would put the current setup in exactly that frame. The danger is not merely that the dollar goes higher. The danger is that too many market participants built comfort around the opposite assumption and use that comfort to justify other risk. Once the foundation shifts, those other risks must be reconsidered simultaneously. That is how a macro story becomes a market event. And I would not dismiss the role of psychology. When investors realize that a favored narrative is breaking, they often swing from complacency to urgency faster than fundamentals alone would dictate. The same people who were relaxed about the dollar can become preoccupied with it. The same managers who had felt confident about equities can begin cutting quickly. The same commentators who spoke about a soft landing and orderly easing can start talking about stress, recession, or worse. Human beings do not update beliefs in smooth, measured increments during pressure. They lurch, prices lurch with them. That is why the early phase of an unwind can feel confusing. Some headlines still point one way, some price action points another. Central bankers speak carefully. Markets interpret aggressively. Oil sends one message, growth data sends another. Currency markets often integrate the conflict faster than equity investors want to. By the time stock investors fully accept what the dollar is implying, the adjustment may already be painful. I would rather listen early than rationalize late. There is also a lesson here about complexity. Modern markets invite people to believe that sophisticated structures reduce risk. Sometimes they do. Sometimes they simply spread one risk through many wrappers. A short dollar position, embedded in institutional behavior, does not have to be announced at a podium to exist. Futures positioning, international exposures, financing structures, and policy expectations. That is why broad macro reversals can surprise people who believe no single obvious bubble was present. The bubble was not in one asset. The bubble was in one assumption. One assumption can be enough. If you assume the dollar will stay weak or benign, the Federal Reserve will become easier, Europe will not crack under energy pressure, and equities can continue to enjoy that combination, then you have built a comfortable little house. If oil rises, Europe softens, the central bank hesitates, and the dollar strengthens, that house begins to shake from every side. I do not say this to frighten anyone. I say it because honest investing begins with naming the mechanism of risk. Once you name it, you can respond rationally. You can trim. You can hedge. You can hold more cash. You can demand better prices for risk. You can stop pretending that a crowded trade is harmless simply because many sophisticated people occupy it. Sophisticated people are often the last to admit when a consensus has become dangerous. They have too much reputation invested in the logic that produced it. The market does not care about reputation. It only cares about settlement. And settlement is merciless. At the portfolio level, this means I would rather enter a more defensive posture before the unwind proves itself in every headline. That does not mean selling everything and hiding under the table. It means respecting what a rising dollar can do when it is tied to energy stress. Weaker European prospects, delayed rate cuts, and crowded positioning, a portfolio does not have to be built for drama, but it should be built for discomfort. If it cannot withstand a stronger dollar and a weaker equity tape arriving together, then it is probably more fragile than it appears. Fragility is expensive because it reveals itself only after prices move. Strength, by contrast, can feel boring before it becomes valuable. I have made enough mistakes in my life to appreciate boring strength. The crowd almost never celebrates it in advance. Cash feels lazy until liquidity becomes precious. Hedging feels unnecessary until correlations tighten. Trimming feels timid until drawdowns deepen. Patience feels old-fashioned until forced sellers create the bargain you were waiting for. That is why I come back to the same conclusion. A rising dollar in a world that had leaned heavily. The other way is not an isolated curiosity. It is a warning that a comfortable macro arrangement may be breaking apart. Energy is part of the trigger. Europe is part of the transmission. Central bank expectations are part of the fuel. Positioning is the accelerant. Equities are where many people finally notice the fire. By then, the important work should already have been done. The important work is preparation. Preparation means understanding that a market supported by expected easing can struggle when easing is. Preparation means understanding that Europe under energy pressure can become a major driver of dollar strength through euro weakness. Preparation means recognizing that when too many institutions are arranged against the dollar, a reversal can force activity far beyond the currency market. Preparation means accepting that you do not need a new financial architecture to get a painful correction. Sometimes an old mechanism is enough. Crowding, leverage, and a broken macro assumption can do plenty of damage on their own. If I had to reduce the whole situation to one lesson, it would be this. Do not confuse a widely shared assumption with a durable truth. A widely shared assumption can make money for a while. A durable truth survives stress. The short dollar view made sense to many participants under one set of conditions, but the world does not promise to preserve. Those conditions: oil can rise, Europe can weaken, central banks can disappoint. Currencies can move first, stocks can follow. And once a crowded trade begins to reverse, logic alone does not control the speed. Positioning does. That is why the world can feel calm right before it does not. I have learned to respect that transition. A market often appears strongest when it has become most dependent on one supportive belief. Remove the belief and strength can vanish quickly. That is what concerns me when the dollar starts to firm up against a market that had grown relaxed about it. I do not see a harmless technical move. I see a possible repricing of risk across multiple assets. I see the potential for institutions to keep reducing exposure. I see the possibility that what looked like a normal pullback becomes something sharper, because too many investors must adjust together. And if that happens, the wise response is not panic. It is clarity. Know what you own. Know why you own it. Know which assumptions secretly support it. Know what happens if those assumptions fail. If your answer depends on a weak dollar, fast rate cuts, resilient European growth, and stable energy prices all at once, then your answer is too fragile for my taste. I would rather own fewer things and understand them better. I would rather give up some upside than be forced into desperate selling. I would rather let other people worship precision while I protect durability. That approach does not win every month. It does something more important. It helps you survive periods when the crowd discovers that the trade it thought was ordinary had become the trade that mattered most. That is how I would read this moment. I would read it as a warning that the dollar may no longer be the sleepy background variable people assumed it was. I would read it as a sign that oil is not only about inflation headlines, but about regional fragility and policy delay. I would read it as a reminder that Europe matters enormously when the euro is the key counterpart to the dollar. I would read it as evidence that crowded positioning can turn a macro shift into an equity problem quickly. And I would read it as a call to act before the forced buying of dollars and the forced selling of risk become obvious to everyone. Because once they are obvious to everyone, the easy decisions are gone. Then the market is no longer offering preparation. It is only offering consequences.